Welcome to Talk Tickers. We're diving deep again, this time into Cboe Global Markets' first quarter results for 2025.
That's right. We've gone through their earnings call, pulled out the key numbers, the strategy points, everything you need to know.
Our goal, as always, is to give you the essential insights, the context behind the headlines. So let's start with those headline numbers. Pretty strong, weren't they?
Very strong. A record quarter, actually. Net revenue hit $565 million. That's up 13% compared to last year.
Okay, 13%, solid. And earnings?
Also a record. Adjusted diluted EPS came in at $2.50. That's a 16% increase year over year.
16%? Wow. So where did this performance come from? Was it concentrated somewhere?
No, that's the interesting part. It was pretty broad-based. Good results from derivatives, obviously, but also cash and spot markets and their Data Vantage business too.
Right. Everyone contributed. Makes sense. Let's maybe dig into derivatives first. That seems like the big story.
Definitely the powerhouse this quarter. Derivatives saw record organic net revenue up 16%.
16%. And what fueled that specifically?
Really strong volumes, both in their multi-listed options and their own proprietary index options.
Yeah,
the VIX, the S&P 500 index options. Those were key drivers.
I saw some specific volume numbers that looked pretty impressive.
Yeah, they were. S&P 500 contract ADV, that's average daily volume, was up 13% year over year.
Okay.
But the XSP contract, the mini S&P, that saw a huge jump. ADV up 61%.
61, that's significant. And VIX-related products.
Also very strong. VIX options ADV increased by 33%, and VIX futures ADV, that rose by 13%.
And did they give any color on, say, April? Did that momentum continue?
They did. They mentioned option volume stayed high in April. They pointed to market volatility around those tariff announcements as a reason. So, yes, seems like Q2 started strong too.
Okay. Now, the Zero DTE options. Days to expiration, that continues to be a massive theme. Right?
Oh, absolutely. A major driver for S&P volume. In Q1, they averaged nearly 2 million contracts a day.
2 million a day.
Yeah, up 29% from last year. And get this, it made up a record 55% of the total S&P volume.
55%. Wow. So more than half of all S&P options volume is now Zero DTE. What's pushing that?
Well, a couple of things. Management mentioned the fast-moving headlines. Investors seem to be using these for really quick reactions, intraday risk management.
Makes sense in this environment.
And also expanded access. They specifically called out platforms like Robinhood, bringing more users, particularly retail, into these products.
Interesting. And is this just a U.S. trading hours phenomenon?
Not anymore, apparently.
Yeah.
Index option volume during global trading hours also hit a record, up 36% year over year.
36%.
Yeah, and they noted significant activity overnight, especially when market-moving news broke elsewhere. It really shows how global and interconnected things are now.
It does. What about new product development in derivatives? They mentioned Bitcoin.
Yes, the Bitcoin index options, CBTX and MBTX. They said adoption is increasing, particularly with ETF issuers. Apparently 15 ETFs are already using them in strategies.
15 already, huh?
And MBTX options actually hit a record volume day on March 31st. Plus, they just launched Cboe FTSE Bitcoin Index futures in late April. So definitely pushing into that space.
Seems like a clear strategic direction. Anything else noteworthy on the derivative side? Corporate bonds.
Right, corporate bond futures showed healthy growth too. Record open interest in both high yield and investment grade contracts could suggest more hedging or positioning around credit risk.
Okay, let's shift gears. Data Vantage. How did that segment perform?
Steady performer. Organic net revenue up 8% year over year. Shows its durability.
8% solid. Any leading indicators there?
Yeah, the really positive sign was the new recurring annual contract value, ACV. That jumped 47% year over year.
47%. That's a big leap. Bodes well for future revenue.
Exactly. And interesting geographically, too, 55% of those new data sales were outside the U.S.
Oh, really? Whereabouts?
Big focus on the Asia-Pacific region. Shows their global expansion efforts are paying off, especially in data.
Got it. Okay, what about the more traditional side? Cash and spot markets.
Also solid growth there. Organic net revenue up 10%. That was across all their regional equity markets.
And they finished that big tech migration project, right?
Yes. Cboe Canada successfully moved to the Cboe Titanium platform. That completes the global migration.
And that platform seems pretty robust.
Apparently so. They highlighted one day, April 7th, where it processed over 1 trillion orders, quotes, and market data events. So, yeah, handling capacity seems strong.
Wow, 1 trillion. Okay. Within cash and spot, any regional differences?
Yeah, a bit. North American equities saw a, let's say, more modest 2% net revenue increase.
Only 2%. Why was that lower?
Well, higher non-transaction revenue helped, but it was offset by lower transaction and clearing fees. They said more trading happened off exchange or during auctions, which impacts those fees.
Okay. Then where was the growth stronger then?
Europe and Asia Pacific. That segment grew 18%, or actually 22% if you adjust for currency.
Much stronger.
Yeah, driven mainly by higher transaction and clearing fees.
Yeah.
Good volumes and market share trends over there.
Okay, turning to costs. How did they manage expenses?
Pretty well, actually. Adjusted operating expenses were basically flat year over year, around $192 million.
Flat, even with the revenue growth.
Yeah, though they did note some favorable timing on marketing spend in Q1, but importantly, their full-year expense guidance is unchanged.
So they expect costs to pick up later.
Seems like it. They mentioned higher marketing costs coming, short-term incentives kicking in because April was strong, and also some costs related to the CEO transition. The guidance stays at $837 to $852 million for the year.
But they're still planning to invest.
Oh, definitely. They plan to keep investing in global sales, marketing campaigns, especially to promote those index options. Seems like they see plenty of runway there.
And given the strong start, any change to the overall outlook for the year?
Yes, they bumped up the full-year total organic net revenue growth guidance. It's now mid to high single digits, up from mid-single digits before.
Okay, an upgrade there. What about Data Vantage guidance?
That stays the same, mid to high single digits organic growth. And other guidance, like CapEx, D&A, tax rate, all reaffirmed.
And net interest expense?
They expect that to be around $2 to $3 million in Q2.
Right. How about capital allocation? What's the plan there?
They're in a strong position. Over $1 billion in adjusted cash, and leverage is low, only 1.0 times.
Pretty comfortable.
Very. So they restarted share buybacks in Feb, bought back $30 million in Q1, another $5 million in April, plus the dividend, 63 cents per share.
So returning capital to shareholders is a priority.
Seems to be, yes. Especially opportunistic share repurchases. Given the low leverage and fixed rate debt, they said buybacks will likely take precedence over paying down more debt right now.
Makes sense. Now, there was also big news on the leadership front.
Right, the CEO transition. Fed Tomczyk, the current CEO, is stepping down May 7th. He expressed strong support for the incoming CEO, Craig Donohue.
And Tomczyk's role going forward.
He'll be an advisor until the end of June, then rejoin the board as a non-employee director.
What was the rationale for choosing Donohue?
They described the search as thoughtful and disciplined. Key factors were his global derivatives experience. He's been a CEO before, and his reputation in the industry. Seems like a solid pick based on their strategic focus.
Yeah, sounds like a logical choice. Let's talk about retail investors. They came up quite a bit, especially around those zero DTE options.
Yes, and interestingly, management stressed the discipline they're seeing from retail. Said 95% of opening trades use capped risk strategies, like spreads.
95%. That's higher than you might expect.
It is. And apparently, even when there were big volatility spikes, retail stayed engaged and came back quickly. They also mentioned the Robinhood rollout of index options saw faster adoption than they expected.
So retail is embracing these tools maybe more responsibly than some feared?
That's the picture they painted. And not just SPX Zero DTE, but using the broader toolkit like VIX options and XSP too.
We touched on Asia Pacific with data sales. Is that a major growth focus overall?
Absolutely. They see huge opportunity there. Growing demand for U.S. index options access. They view data consumption in APAC as a leading indicator for trading appetite.
Then they're investing to capture that.
Yes. Onboarding new clients mentioned Korea and Taiwan specifically in Q1, putting in new salespeople, targeted marketing, more education, market intelligence for that region.
Okay. What about institutional clients? Still engaged?
Yeah, they said engagement remains strong, especially during volatile periods when institutions are adjusting and repositioning. They feel they maintain good market share in S&P options within the broader complex.
And just circling back on Zero DTE one last time, the trend is still firmly upward?
Seems so. Continued strong growth across SPX, XSP, even Russell contracts. Driven by that need for nimble risk management, reacting to news flow, they feel the liquidity ecosystem is robust and balanced too, with diverse participants.
So how do they see themselves competitively? What's their edge?
They believe it comes down to a few things. The depth and richness of liquidity across their whole volatility toolkit, how their products complement each other, and decades of innovation in their platform. Plus, that diverse ecosystem, different user types, bringing balanced activity.
Right, the whole package. Okay, that's a pretty thorough look at the Cboe call. Shall we move to our This is not financial advice segment. Time for an outrageous idea.
Let's do it. All right, so thinking about Cboe, the Zero DTE focus, the news-driven volatility, here's a purely hypothetical, definitely a high-risk scenario for you to ponder.
Okay, brace yourselves.
Imagine a major news event is coming up. FOMC decision, key inflation print, something like that. Just before the announcement, you put on a very short-dated, like 0 DTE or 1 DTE, straddle on the S&P 500, betting on a big immediate move up or down.
Okay, classic volatility play. What's the outrageous part?
The twist is, at the same time, you also sell a wider strangle, short and out-of-the-money put, and an out-of-the-money call may be expiring a day or two after the event.
Okay, so buy vol, sell vol further out and wider. What's the theory?
The theory, and this is highly speculative, is the straddle potentially captures the immediate explosion in volatility and price movement right around the news. The short strangle aims to collect some premium to maybe offset the straddle cost if the market doesn't make a massive, sustained move beyond those wider strikes, or if volatility crushes back down quickly after the event.
So you're trying to catch the spike, but also benefit if it fizzles or stays within a range afterwards?
Kind of. It's like trying to catch lightning in a bottle with the straddle while setting up a small safety net, or rather a premium collection net with the strangle. But the risks are huge.
Oh, I bet. You could lose on both legs easily. Wrong direction, vol crash kills the straddle, market moves enough to hurt the strangle.
Exactly. Massive risk. Requires precise timing, understanding of volatility dynamics, options pricing. It's complex. Definitely not a recommendation, just a thought experiment playing on the themes from the call. Experienced traders only territory, if even that.
A very intricate, high-stakes thought experiment indeed. As always, everyone, do your own research, understand the risks completely. Okay, that was quite the deep dive into Cboe Global Markets Q1.
We covered the record results, the drivers, especially derivatives, and zero DTE. The data growth, the tech upgrades, the outlook, the CEO change, lots happening.
What stood out most to you listening in today? Is it the relentless growth of short-dated options, the Asia-Pacific push, maybe the retail discipline aspect? Something to chew on.
Yeah, definitely food for thought. Keep digging into the details that matter most for your own strategy.
Thanks for tuning in to Talk Tickers. We'll be back soon with another breakdown. Until then, keep a sharp eye on those markets.